This is Chuck Carnivale. I'm the Chuck in the Markets Up Chuck, and today I'm going to talk a little bit about cap size. It's one of the things that really frustrates me. You know, when I first got in this business, we talked about growth in income, aggressive growth in income, moderate growth in income, and it was kind of designing investment portfolios based on the risk tolerances and needs and age and so on of the investor. But today everything is about style boxes, and we talk about cap size quite a bit, large cap versus small cap. So today's blog was titled Small with Room to Grow, and I just want to make a point. It always never, it really has little to do with the style box in my view. In other words, it's not the cap size that matters. Here's a company that's only a $174 million market cap, Silicon Image. You can see they went public towards the end of 1999. They had, like a lot of IPOs, they had a great run up, and then the stock price, of course, kind of, fell, and then it rallied again. Then it finally fell completely because as time went on, they really didn't make any money, and then they finally did generate some profits, back here in, I guess, 2005. But what I want you to notice is their profit has actually been shrinking since then, and now the stock price is following in that. So even though the company has no debt and it's only a $174 million market cap, had you invested $100,000 in it on October 29th, 1999, that $100,000 would have shrunk, to $10,502. That's a minus 20% compounded rate of return during a period of time when, by the way, the market was bad. Also, the market was down 2%. But clearly, this company dramatically underperformed, the stock market. So it wasn't the market and it wasn't its cap size that mattered. It really had to do with the, prospects of the individual business. Now, another company that was started about the same time, not quite, but, very close, was a company called Catalyst Health Solutions. I want you to notice they had no earnings at first, which is kind of common for the first couple of years. But then once they started making money, look how their earnings just grew and grew and grew. Went from 17 cents a share up to $1.48 estimate this year and $1.84 next year. The company's had 34.7% average growth over this 12 years. It's now a $1.5 billion market cap, which is a small cap, and some people might even consider that mid-cap, but it's certainly a small mid-cap if it's a mid-cap. But $100,000 in this company on 12/31/1999, a couple of months later, would have grown to $291,000. That's an 11.4% compounded rate of return, again, during a period where the stock market lost minus 2.8%. So the bottom line is it's not about cap size. It's not about what the market's doing. It's all about the individual companies you own. And, so when you're looking for a small cap or a large cap or a mid cap, the point really comes down. You always want to look for a company that still has room to grow, because how well the company's run and what business it's in matters a lot more than what the markets are doing. It's Chuck Carnivale saying thanks for listening, and talk to you again tomorrow.